In this presentation, I will explain the mechanics of my speed equity system and how you can use it to take advantage of the most important key principle in banking to slash years off your home loan and save tens of thousands of dollars in interest. And that is, the interest on your mortgage is calculated on the daily balance. Let's say we took out a mortgage for $250,000 at 6% over 30 years. In order to pay back this loan, we would have to make monthly payments of approximately $1,500 for the next 30 years. Now, this is the way most of us have been taught and encouraged by the mortgage and banking industries to manage our money and to repay our mortgage. We have a checking account into which we deposit our income. Once a month, we make our mortgage payments by online banking or by writing a check to the lender. What's left over in the checking account, we draw out for living expenses using an ATM card or a checkbook. Does this sound familiar to you? Well, that's what we've all been taught and encouraged to do by the mortgage and banking industries. And if that's the way you're managing your money and paying off your mortgage right now, then that is guaranteed to keep you in debt for a very, very long time. Let's take a look at our typical mortgage and see what happens to it. Remember our key principle: interest on your mortgage is calculated on the daily balance. And the daily balance on a typical mortgage stays high and stays the same for the entire month until you make your payment. And a large chunk of your mortgage payment goes toward paying the interest on that loan, and only a very small portion goes toward reducing the loan balance itself. This then gives you a new daily balance for the following month that stays the same until you make your next monthly payment. And this cycle repeats itself month after month for the next 30 years. I'm sure you're familiar with that if you've looked at your mortgage statements recently. Here's what happens to our $250,000 mortgage over the years. After 5 years, 10 years, 15 years, after 20 years, we would have paid more than what we borrowed and still owe more than half of the original loan amount. After 30 years, the total payments on our loan will be over $500,000. That's because along the way, it will also cost us almost $283,000 in interest. But the real cost of this $250,000 mortgage for the average family is over $730,000. Why? Because you have to work really, really hard to earn this money, pay the taxes on it, and these payments are made with after-tax dollars. So if you have a 30-year mortgage right now, the real cost to you is almost 3 times what you borrowed. Another way to look at this is that you're really being forced to pay for 3 houses with your hard-earned money. 1 for you and 2 for the bank. And that's just the way they like it. So how can you own your home years sooner and save tens of thousands of dollars in interest? Use the speed equity system. Let me summarize for you how it works. In essence, as soon as you get your paycheck, you transfer that money straight into your mortgage, which dramatically reduces the daily balance. And because interest is calculated on the daily balance, this has the effect of reducing the amount of interest you pay. In summary, the speed equity system helps you to use your existing financial resources to keep the daily balance of your mortgage as low as possible so you pay the least amount of interest. And your money ends up working much, much harder for you. Instead of earning around 0.1% in interest by sitting in your checking account, you could be saving up to 6% in interest by having that very same money sitting in your mortgage instead. The best part is that with the Speed Equity System, we show you how to access your money for living expenses as you need it. Let's recap for a moment. With the traditional mortgage, you only reduce the daily balance once a month and by a very small amount each time. But by injecting your paycheck into your mortgage, you dramatically reduce the daily balance by the amount of income that goes into it. And remember, we show you how to draw out your money for living expenses as you need it. You see, you will be saving interest in two ways. First, the money you don't use will stay in your mortgage, keeping the daily balance low for the following month. Second, the money you do need will also save you interest by keeping the average daily balance for the month down until you use it. These savings will roll into the next month in the form of a lower daily balance, and this new cycle will compound month after month to save you more and more interest. Ultimately, with all this knowledge and the help of our software program, this revolutionary way of working smarter will allow you to slash years off your home loan and can save you tens of thousands of dollars in interest, all without changing your current spending. In the past 12 months, I've been conducting coaching workshops and showing American borrowers how to apply the Speed Equity System in their lives. All the data we gathered from our workshop participants shows that the average amount of time they're saving on their mortgage using the system is 16 years, and the average amount of interest it's saving them is over $109,000. Again, all this without changing their current spending.